All right, we all have dreams, right? And a lot of those dreams, well, they need money to become a reality. Today, we're going to pull back the curtain on one of the most popular ways to make that happen: mutual funds. We'll break down exactly what they are, how they work, and most importantly, how you can actually get started.
So let's get real. We all have these big goals in life. Maybe it's buying a house, making sure our kids get a great education, or just kicking back and enjoying a comfortable retirement. But how do you get from the savings you have in the bank right now to that life you're imagining? Look, it's not just about saving more. It's about making the money you already have work way, way harder for you.
You know, the first step on any investing journey isn't picking a stock or a fund. Nope, it's understanding your why. What are you actually saving for? Your goals are totally unique to you, and they all have different timelines. Let me show you what I mean with a few quick stories. So, meet Shalini. She's 8 years old, and she's got her heart set on being a space scientist. Awesome, right? Her parents know that a top-notch education is probably about 10 years down the road. That's a classic long-term goal. They're going to need a pretty big chunk of money, but the good news is they've got time on their side to let their investments really grow.
Okay, now here's Surinder. He just landed a promotion. Congrats, Surinder, and he's moved to a bigger city. He's really keen to buy his own place, maybe in the next 2 or 3 years. This is what we'd call a medium-term goal. He needs to grow his down payment for sure, but he can't get too risky with it, since he needs that cash relatively soon.
And finally, this is Mrs. D'Souza. She just retired and has this lump sum from all her years of hard work. Her goal? It's immediate. She needs that money to start paying her a regular, steady income so she can live comfortably for the rest of her life. So her need is both right now and very, very long term. Now, here's the interesting part. Shalini's parents, Surinder and Mrs. D'Souza, they're all facing the exact same invisible enemy. It's this silent threat that's constantly trying to sabotage their goals by chipping away at the value of their money.
And here is that enemy in a single, frankly, shocking number. Let's say something costs 10,000 rupees today. In 20 years, assuming a pretty standard 8% inflation rate, you'd need almost 50,000 rupees to buy the exact same thing. That's how much buying power your money loses. If your cash is just sitting in a savings account, you are actively losing ground. You're going backwards.
And that right there is what we call inflation risk. It's this silent killer that just eats away at your money's value. It means that just saving your money, it's not going to cut it. You have to invest it to really grow your wealth. So the big question is, how?
Well, this is where you need a bit of help. A powerful tool, a way to basically outsource the super complicated job of investing to a whole team of pros. And for millions of people, that solution is a mutual fund. Think of it like this. Instead of you having to become a full-time stock market genius overnight, you just pool your money together with a bunch of other people. And with that bigger pool of money, you can collectively hire a professional team. They're called an asset management company, or AMC, to do all the research and heavy lifting for you.
So, how does it actually work in practice? It's pretty simple, really. First, you and thousands of other investors all put your money into one big pot. Then, the professional fund managers at the AMC take that big pot and invest it in all sorts of different things, like stocks and bonds. And in return for your contribution, you get units, which are basically your little slice of that huge investment pie. Now, doing it this way gives you 3 incredible advantages. First, you get top-tier professional management without having to be a millionaire. Second, you get instant diversification, which is just a fancy way of saying your risk is spread out. And third, you get what are called economies of scale, which means lower costs because the fund is buying and selling in huge volumes.
And this is what that diversification looks like. Even with a small investment, I'm talking as little as 500 rupees, your money is instantly spread across a whole portfolio of different assets. So if one company has a bad year, it doesn't drag your entire investment down with it. It's that classic rule you've heard a million times. Don't put all your eggs in one basket. A mutual fund does that for you, automatically.
Okay, so let's say you're on board with the idea. You're ready to invest. Your first big decision isn't about trying to pick one perfect fund out of the thousands that exist. It's simpler. It's about choosing your main strategy. Are you playing for long-term growth, or do you need stability and income right now? And that choice really boils down to two main flavors. On one side, you have equity funds. They invest in company stocks, and their whole goal is growth over the long term. Now they come with higher risk, but they also have the best shot at beating inflation over many years. This is perfect for a long-term goal, like Shalini's education. On the other side, you have debt funds. They invest in more stable things like bonds. They have lower risk and aim to provide a steady income. These are much better for shorter-term goals like Surinder's house or for generating that regular income Mrs. D'Souza needs. So, at the end of the day, it's a trade-off. With equity, you're accepting more bumps in the road, more volatility, for a shot at much higher growth down the line. With debt, you're giving up some of that growth potential in exchange for a smoother, more predictable ride. Neither one is better than the other. It's all about matching the tool to your specific goal, your timeline, and what you're comfortable with. Okay, so you know your why, and you understand the basic choice between growth and stability. So how do you actually start? How do you take that first step? Well, the great news is it has never, ever been easier to begin. A really popular way to start is with what's called a systematic investment plan, or SIP. I love this analogy. Think of it as a subscription service for building your future wealth. You just invest a fixed amount automatically every single month. It builds an amazing saving habit, and it takes away all the stress of trying to guess when the market is high or low. It's a powerful, simple, and steady approach to building wealth. You also have a choice in how you buy your funds. You can go with a direct plan, which is for the do-it-yourselfers out there. You buy straight from the fund company, and because there's no middleman, the costs are a bit lower. Or you can use a regular plan, which you buy through an advisor or a distributor. They give you guidance and handle the paperwork for you, and that convenience is paid for through a small commission. Both ways are perfectly fine. It just depends on whether you prefer to go it alone or have a co-pilot. So if you take away just one thing from all this, let it be this quote. A mutual fund isn't some magical different product. It's a different way of investing in the exact same things that build wealth, like stocks and bonds. It's just a method that bundles up professional help, instant diversification, and government regulation into one easy-to-use package. So the real question isn't what you've learned here, but what are you going to do with it? Now that you know your goals, you see the danger of inflation, and you know the tools that are out there, what is the first small step you are going to take for your future? It could be as simple as writing down a goal or just researching one fund. Whatever it is, the most important thing is just to start. Thanks for joining this explainer.